Hello and welcome to the Halifax Real Estate Podcast. I am your host, Jason Paul, licensed realtor in Halifax since 2017 and team lead of the Infinity Real Estate Group at eXp Realty of Canada, Inc. This podcast was created to help you understand a little more about the Halifax and Nova Scotian real estate markets. If you like what you hear, I would really appreciate it if you hit the subscribe button. Thank you so much and enjoy the show. Matt and I did an episode a few weeks ago about whether homeownership is an investment or not. And within that episode, we came to find out that if you were to purchase a $600,000 house and fulfill your 25-year amortization, you would pay out $349,000 in interest. Gross. I know. So Matt and I decided to tackle all the different ways homeowners can pay down your mortgage and amortization. For instance, there's a simple trick at the start of your mortgage that immediately takes 3 years off your amortization. There's that and so much more. Welcome back, Matt, and enjoy the podcast. You are live now, so be careful what you say and how you
Hi,
act.
Internet.
Act accordingly.
Hello, Internet.
We're not live on YouTube or anything though. I'm not allowed to do that yet.
You know what? They've got to have safeguards at some point.
They let us play.
Yeah, at some point it's just like, no, this is too much.
Really fun thing. My father-in-law saw a few of our clips, and he goes, I was on FaceTime with him, and he goes, Jay, the swearing. He goes, you're putting this out. I go,
yeah.
Well, I'll put you in my thought process. If people don't, I go, I swear, this is how I speak. If they don't want to work with someone who swears, let's just weed them out early.
Well, and you see those articles now where they talk about people who have a higher intelligence level if they curse a lot, right? So, like, I'm really hanging my hat on that.
Oh, it's sarcasm.
I got that in spades.
If you have yeah, if you are a sarcastic individual, it means you have a higher intelligence. And I'm like, great. I'm actually a certified genius.
Not a single one of my teachers would have ever agreed with that, but I'm happy that the rest of the world is catching up to it.
My wife doesn't even agree to that.
I mean, that's pretty fair. She's got to live in close quarters with you, so she's probably like, I'm done with the sarcasm.
I'll tell you what. Funny little anecdote. I'm a gamer, but I'm like core like franchises. And the new Resident Evil game just came out, and they bundled it with the last 3 games. And I hate horror. I hate horror films. Can't do them. Don't watch them. Leave them alone. I have been sucked into the world of horror video gaming for the last like 2 weeks. And like, I play soccer, and the adults always get like 10 p.m. kickoffs. So like the game ends at 11:30. You get home at midnight, and I'm wired till 4. Yeah. So I am just in my house alone from like 12 a.m. to 4 a.m. shooting zombies and screaming because I'm terrified. And like the amount of time she's texting me like, I hate you, go die. Or like, I'm going to throw, like the classic one has been, I'm going to break your Switch if you do not. And I'm like, anyway, just my life.
I remember the Resident.
That's why she thinks.
I remember the Resident Evil games when they first came out. See, I'm more of like a laid back kind of like a Red Dead Redemption guy, where you just take a little bit of time, jump on a horse, just kind of cruise around on a horse, just live in the pioneer dream, maybe hijack a train or something funny, like that's obviously.
We had friends over the other night, and Anya's giving me shit being like, he's scared of video games. Like, he jumps, like he screams when they pop out. I'm like, no. I'm at a part right now. I'm going to fire this thing up, and you're going to, if you don't jump, you're all crazy. Sure enough, fire up the game, put them all in front of it, and was like, wait for it. They didn't know what was coming. And I turned a corner in this dark with a flashlight, and this big, ugly zombie just reaches out and like kills me instantly. And they all screamed, and I'm like, cool. Anyway, we are podcasting.
Sorry, yes, we are here to talk about things.
Mortgage
related. Yeah. Real estate related.
Okay, so the reason for this episode, we had a mortgage pay down clip on Instagram go really, really well. It caught some heat. clearly there's an appetite for this. Clearly people want to learn more about this. So, mortgage pay downs. What is a mortgage pay down, Matt?
It comes in several fashions, right? Like it's the ability to essentially pay your mortgage down faster than what just through your simple principal and interest payments, right? So, each lender is going to offer you, has their own little guideline as to how you can capitalize on that, right? So, first and foremost, there's your prepayment privileges, right? So each bank has their own little guideline for that. How you structure the payment right from the get go can affect that, right? How you manage any cash windfalls throughout the year, right? And there's opportunities that you can put that onto your mortgage. So, your mortgage in and of itself is designed to be slow. Like the bank
Yeah.
wants you for 25 years worth of interest. It's just, you don't have to give it to them, right? Like they very much, and again, they're great, but a bank is a business and a bank wants to make money. So in the back of their mind, when they see a 25-year or 30-year amortization, they're calculating how much blood they're going to get out of the rock. And unfortunately, guys, you and I and everybody else that owns a mortgage is the rock, right? And you don't have to, right? Like you can take advantage of it and they have those opportunities there. So it's just, again, it's just another mechanism so that you don't have to be there for the 25 years. You don't have to be there for 30 years, right? Like you can fast track your mortgage just outside of the payment.
Okay. So the clip that we're talking about was on my Instagram. We collaborated on it. It was like a $600,000 purchase, which has been in and around the average sale price in Halifax for the last few years. Is 349,000 in interest payments, which I'm guessing was the clip and the headline that made everyone watch that thing, because that is a substantial amount of interest to accumulate. And did you see the realtor that got at me on Facebook?
No.
Oh, I had a realtor like come at me. Be
Come at
like,
me, bro.
yeah, yeah, like literally, like literally commented on the face. It's like, and this is like 10 o'clock at night. Like you get this random
Ooh.
post, like
So
random
they were like
comment of
up
like,
late and cranky.
yeah, yeah, and it was like along the lines of like, no one's gonna live in a house 25 years. This is just you're just sensationalizing mortgage payments. Da, 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 da. And I had to be like, if you actually do the math, in brackets, I didn't do the math, the mortgage broker did the math. It calculates to this. Like this is a thing. And then they were like, well, interest rates fluctuate every 5 years. And I'm like, okay, but we can't gauge, like, I can't math that out for 25. Like, try to like, and
Oh,
Anya's watching this in real time, being like, what are you? I'm like, I'm in now.
listen,
Anyway,
again, I love a good argument. Times, the person doing the arguing is maybe not necessarily, I don't know, worth the effort. But here's the thing. Yes, people take mortgages for 25 years. My folks bought
yes.
a house when they were in their 20s, and guess what? They sold it after 25 or 30 years. Let's be serious. Just because you're out there saying everybody should flip a house in 5 years or move and all this other stuff doesn't make it actually true. So, yes, some people are literally not in the game to continuously turn over houses and buy and move and upgrade and everything else. Some, crazy thought, just want a roof over their head in an area that they like and they stay there. So, like, while
Don't
I'm sure this person
don't
had the
tell
best of
realtors, Matt.
intentions,
Don't
I'm sure.
don't tell realtors.
Well, listen, I also wouldn't talk to them about the financial side of things and those aspects of a purchase because really, like, seriously, that's not a losing argument for one. So, but my thing would be, yeah, some people do want to stay in that house for 25 years. They're, that's the security. That's where they're happy where they're at, right? And yes, of course, I would say it's an exaggeration. That is the true amortization period of a 25-year mortgage and what you would pay for interest, right? The the
So
the
this
goal
is
was
the
to
this
spur the
is
thought of like, hey, you don't have to do it this long.
this is the prompt of this episode topic is three a $600,000 purchase and a $349,000 in interest payments over 25 years. So why that is such a significant amount of money to pay over 25 years. You're paying over 50% of the home price. So
Yeah.
like, okay, what are ways? Give me a really simple. What's the first standard method of getting that interest payment down? What's the first strategy people can do at home?
The first strategy, and this is one that I mean, it's the most basic of strategies, and like probably most don't think of it. And if anything, I understand why they don't think of it, but it's the down payment. Like first and foremost, what you're putting into the house, that matters, right? So and I totally get it. Like, listen, not everybody has a tremendous amount of savings to just put onto the mortgage at 20% down, 30% down, or whatever. But you have to realize there's a correlation between putting the minimum down, then you've got mortgage insurance premium on it, and then you've got the duration of the mortgage or stretching out the amortization. That's all going to affect how much interest you pay over time. So again, if your situation dictates minimum down, fantastic. That's why the opportunity's there. But just realize that this is also attributing to how much interest you're going to pay over the term, right? In the amortized period. So like, again, low hanging fruit there. Just like, what are you comfortable putting down and what do you have available putting down, right? Like I had an awesome client this week and chats with them where they've got a substantial amount saved up for down payment. And those are the conversations we're having where it's just like, well, if you put all of it down, this is your payment. This is what's going to look like over the term. But also, as soon as you're in the house, what's everybody want to do? They want to make the place theirs. So I'll see
Yeah.
you all at Home Depot on the weekend, right? Like I'm there every weekend. Costco, I'm there every weekend, right? So like I get it, paint's expensive. So like then the conversation becomes, well, knowing that, do we want to save a little savings on the side to have those, opportunities to improve and all that other stuff, right? But I mean, that would just be the one that's kind of first and foremost. Um, the big thing for me is your payment structure. How you pay your
Okay.
mortgage really matters, right? So a lot of folks, it's just monthly payments or biweekly payments, and that's all fine and dandy, but it's accelerated. Accelerated is where you want to go, right? The accelerated biweekly payment, the accelerated weekly payment, as long as it has accelerated at the start of it, that is where you're already picking up an advantage. On 25-year
Okay.
amortization, if you've accelerated your payments, you're dropping your amortization period by like 3 years, right? Just
Okay.
because what happens with an accelerated payment is the little bit of extra that you put on to that payment, and it is truly a marginal increase on the payment. That little
I was
bit,
gonna say,
go ahead.
3 years, if you're doing accelerated payments, doesn't seem like that big of a jump for accelerated payments.
But just think, it happened the first day, right? So just by simply structuring your payments to an accelerated payment, the 25-year amortization that you have on your mortgage is now 22. You haven't even made a payment yet. Because what happens is every little bit extra on that accelerated payment, when you account for that little bit of extra on every single payment throughout the year, you're effectively making another payment in totality on the mortgage. Only that one whole payment is going directly to the principal.
Okay, so hold on, let me get this straight. You're signing your mortgage, you bought a house. How does how does the standard accelerated payment work? Is it so my mortgage, for example, just we'll use mine, comes out on the 28th of every month, end of the month, and it's 1,300 ish. So if we were to do an accelerated payment, is that is that another $1,300 payment coming out sometime in the month, or is it on top of my already established mortgage payment?
So let's say it's like, let's look at it like biweekly, right? Like, so you've got your monthly payment, or you can split it and do it biweekly and pay twice, right?
Okay, so 650 every 2 weeks.
If you do an
Yeah.
accelerated biweekly payment, your biweekly payment is going to increase just a little bit. Okay, so it's still going to happen at the same time, biweekly. It's just you're paying a little bit more on the payment. And when you calculate that little bit more that you're paying on each one of those payments over the course of a year, you've effectively taken an entire payment and put it right on the principal. So
Okay.
it
So when you say,
accumulates those little bit extras throughout the year. And then the bank
yeah,
does that calculation. And then effectively what's happening is that accumulated amount is going straight to the principal, because on every payment there's principal and interest that are split, and it's it's the gross part about the amortization schedule when you get it and you realize in the first 5 years what you've actually put on the principal as opposed to what you've paid in interest, right?
yeah, it's gross.
And so by doing the accelerated payment, you're going to see that shift, because that little bit extra on each one of those accelerated payments is going to accumulate to effectively be one full payment that would have went directly to the principal. And
Okay.
to fast track the principal is truly the quickest way.
So just so I understand this. So I start out with my end of the month payment, 1,300 bucks. I then go to biweekly. So now I'm paying 650 on the 14th, 650 on the 28th. We're then adding a little additional extra on the first biweekly to
And the
equal.
second. So every single payment's going to have a
Oh,
little extra to it. Oh yeah. Every
okay.
payment that moves forward. So like you're going to have biweekly versus biweekly accelerated. The the frequency of the payment stays the same. It's just the amount that each payment is just a little higher, right? So instead of being 650, right, every biweekly, it might be like 675 or whatever, like just a
Okay, so
small
like
increase.
20, $25, $10,
Yeah,
15,
like
20,
it's
25.
whatever that is
Like
based on the
crazy.
principal and the mortgage and all that stuff. But like when that breaks out, there's just a little increase on that biweekly payment to make it accelerated. And then so like if you add up every little increase on every single one of those biweekly accelerated payments, that effectively equals 1 month's payment or one full payment, and then boom, that goes towards the principal, right? Because every little bit
And
that
that
they add onto the accelerated payment, they throw right to the principal.
and that is 3 years off the top.
Right out the date. Like just
3
by
years 3
just by
years
selecting
gone.
the payment, and we do this in our
Yeah,
budget summaries. Like when I present a budget to a client, I'm going to show you in the spreadsheet. Okay, here's what everything would look like if it was 25 years. Here's everything would look like if it was 30 years, and then right below that, I've got just by choosing accelerated, your 25 goes to 22 and your 30 goes to 27-year
okay.
amortization.
How often do people go for accelerated? That one.
I am seeing it more often. I'd like to think it was because of our YouTube chat. Um, I'd like to think it was because of the video, but no, honestly, it's interesting, right? Because it's one of those things. Like if you've never
No
had
one
a
knows about it.
no, and if you've never had a house and you've never had a mortgage, you do not know what you do not know. So like,
Yeah,
it's just everybody thinks, well, I like monthly payment, or I like to see it every 2 weeks, or maybe I like to see it weekly, right? I know some that prefer the weekly, and then they do the accelerated weekly, right? And it's the same
yeah.
idea. That weekly payment's going to have a little bit added to it that's going to go straight to the principal over the year. But I'm seeing it more and more just because I know for myself, I make a point to illuminate that in the video by being like, just by doing this step. And a lot of folks, it's like, oh, I didn't even know, right? And so it's becoming more prevalent, I think. At least I'm finding with my clients, but I think that's also just because I'm making a point to be like, hey, let's take advantage of this.
Right.
It's an easy win, right? But
And
others,
you're starting to see and you're starting to see more and more people sign up for this accelerated payment to pay down that debt.
yeah, right. Because once you frame it and you explain it to them, it's like because you can already afford the payment, right? Like if you're in a position and your ratios are good, and we're just simply talking about the payment structure, you're going to
Right.
be able to afford the payment now. Um, Does it align with your budget? Like a lot of folks, it's like, okay, I want my payment to come out just after my pay stub and all that stuff, which totally makes sense. So a lot of times if they're paid biweekly, that puts them into that biweekly budget. If some folks, I know my partner has the weirdest pay period I've ever seen. Like it's like I can't even explain it. I think it's like the 15th and the 28th of every month. I'm like, who, like, what is this? Um, but that may be something where if she was a client, they may say, okay, well, I'd rather have it at the end of the month because I can understand my cash
Right.
flow. Right. But,
Yeah.
um, yeah, for me, it's like, I just position it because my experience personally with my mortgage when I first had it, I couldn't believe it. Like, my first mortgage, I did the accelerated payments because my broker at the time explained to me the nuances, and I was like, awesome. And then annually, I took advantage of the prepayments, and within my first 5 years of a 25-year mortgage, I was at like 17 years amortization, 16 years. Like I cut
Okay.
8 years off my mortgage in the first 5 years because I took advantage of pretty much every opportunity I could. There was one I didn't because it was like, who has a bag of money every year to drop on the mortgage? But we can talk about that because there is
Oh, we're
opportunities
gonna
throughout
get
the year.
there.
Then you may come into a windfall, right? Like tax
Yeah.
time, right? Like you get your
Right.
tax return, right? Or an inheritance, or I don't know, maybe you win a Good Set for Life ticket or something at a needs on a Friday, right? But um, there's ways that you can do it that if you put the focus on the mortgage, you can pay it down quickly, right? Now, I get it. Everybody's financial situation is different, but
So, okay. we bought a house, we're doing accelerated payments, we're already off 3 years. I'm down to 22 years. What is the next strategy for us to do mortgage paydowns?
Next would be increasing your payment size, right?
Okay.
So through these prepayment privileges, the banks range from about 10% to about 20%, right? So it's like 10 over 10, 15 over 15, 20 over 20. And basically that is once a year, you can increase your monthly payment on the anniversary date of your mortgage. So let's say you get a mortgage, what's today? March 19th. So let's say we got a mortgage today.
We'll just use mine. We'll just use mine as the example because I actually know my dates. Is it when I buy the house and when I close on the house, or when my first mortgage payment comes out?
So when you
When I close on the
close.
house.
Yeah.
Okay,
Yeah.
January
Your
31st.
date of advance, right? So when the money
Yeah.
comes to you,
Okay.
that's your anniversary date. So,
Okay, January 31st.
so with a 10 over 10 or a 20 over 20, on that January 31st, you have the option to now increase your payment by 10% or 15 or
Is
20
this
based on the policy of the
is this
banks.
right when I close, like, on the day I can call the bank and be like, I'd like to do a 10 over 10. Do I set it up before?
So on your commitment, and this becomes a strategy when you work with your broker as to explain what your goals are at the start. Like if a client comes to me and says, okay, my goals are, I want to pay this mortgage off as fast as I can. Instantly, I'm focusing on banks that have the most aggressive prepayment schedules. So 20%
Okay.
over 20%.
Would that be big lender, like A lenders, B lenders? Who are we looking at?
Most it's probably a monoline lender. I know some of the big banks have some fairly attractive prepayment privileges, like
But it's not who
15%,
but it's not who you're going to.
but I've got monoline lenders that would do 20%, right?
Yeah, okay,
To your
cool.
question about the day that you close on your mortgage, when we fill out your commitment letter, you're going to pick your payment schedule, like so the accelerated, say we do accelerated biweekly. Um, in that document, we're going to review what their prepayment options are. So in this case, it'd be 20%. So then I'd be like, okay, Jay, a year from now, you're going to be afforded the opportunity to increase this payment by 20%. You can't do it the day of because you've already set your payments. It's in the future. It's when you on your first anniversary date, then you could take advantage of that. Now, some of them allow you to do it throughout the year, right? Some banks will allow you to add potentially like a minimum of $100 a month to the payment every month, as long as you don't go over that 20%. So what they do is they say, you get 20% increase, or you can put a 20% lump sum payment down. So that's when I was saying I didn't take advantage of everything. I wasn't rocking 20% of my mortgage balance to be able to just drop on the mortgage, right? If I had won the lottery, maybe a little different, but and again, that's tax returns, right? Maybe you get a tax return, a nice big tax return, and you don't want to go to Mexico or Vegas. I would, but
I'm going to Mexico and
I,
Vegas. Maybe not Mexico right now and Vegas right now, but we're going somewhere.
well, I'm going to Mexico
Right.
next week. Yeah, I'm going. The heck with it. Yeah,
You're
yeah.
going to Mexico next week?
Yes. Um,
Okay.
oh yeah, we can talk about that later. Um,
Yeah.
but yeah, so you can increase your payment once a year to 20% if that's the guideline, or you can put a 20% lump sum onto the payment, and it's based on 20% of what your original balance was. Okay.
'Kay. So
Um,
okay,
Go ahead.
let me just because I wanna keep track of everything we're talking about for myself and the audience. So, okay, we're buying a house. We set up, biweekly accelerated payments. So my 650 biweekly comes out the 14th and the 28th, and I'm instead of paying 650, I'm paying 675 for both payments.
Don't quote me on the
Boom.
number because I don't have it in front of me, but you'd be
No,
paying
no,
over the
no, I know.
payment.
I'm
Yes.
just I'm
Yeah, yeah.
just I'm just giving
For
ballparks here, right?
context. Yeah, yeah.
That would equal 1350 for a total mortgage payment a month. But then 3 years off my amortization, wiped out. Cool. Then I close on the 31st. I get the keys. I bought 22. So on 23 on January 21st, on January 31st, I then have the opportunity to do a 20% increase in my monthly payments, or I can do a 20% large sum down off of the original balance that I paid when I bought the
You
house.
nailed it. And if that's the bank's policy is 20%, then those are the numbers. If it's 15,
Yeah.
just know that it's representative to 15. If it's
Right.
10, it's 10. Some banks
Okay.
will only let you do the one or the other, like the lump sum payment or the payment increase. Other banks will allow you to slowly add more money onto the mortgage every month, as long as you don't go over that overall percentage guideline that they set out. But in either case, those all go straight to principal, right? Like those, right? Those increases are going to,
Right.
nail the principal. And
Okay.
like,
All right. So we're just gonna go. I'm going through my entire mortgage just so that we know, because I want some numbers for context here. So if you go, if we go, we paid 270. We paid 230 for the house. We added 40K for purchase plus improvement. So I had a mortgage of 270 when I bought the fucker. If I were to do the 20% after a year in 23, 20% of 650 is $130 a month. So my payments would increase to 780 and 780, which is 60 a month in mortgage payments, but that's directly on principal. And if I had a large bag of cash, I could put down $54,000, which is 20% for okay. Okay.
now
And
it
how much
doesn't have to
yep,
be the full 20%. Right?
right.
Like when
I
it
can do
comes to
up
the lump
to.
sum payment, exactly. That's the ceiling, right? So like if you happen to get a
Okay.
$5,000 tax bonus or whatever
Right.
tax return, you could drop that on it, right?
Okay.
At that time frame.
Let's Let's do this. Okay, so I'm on accelerated payments and I take advantage of the 20%, but I increase the payments because I don't have a windfall of cash. But an extra $130 a month is, I've literally increased my original mortgage payment by 250 a month, which is, and realistically speaking, you're at 3 grand, an extra 3 grand a year. So maybe I'm just not eating out as much. So how much amortization do I wipe out with the accelerated payment program and the 20% on top?
The 20% I'd have to run through an amortization schedule just to see what the value would be. But again, it's shortening that amortization period. And so then all of a
Because
sudden you
it's
start to
directly on
just,
the principal.
yeah. And then you're going to
Is
start to
all
see the
all
total interest reduce, right?
right. By by doing it this way, we and everything we're talking about, the accelerated payments and the 20%, the 20 on 20 on 20 you called it?
20 over 20. Yeah.
Man, I'm getting close. Okay, the lingo.
You'll be
So
a
if I do
broker
accelerated
soon.
payments at fuck off. Fuck off. You say you hate to do my job, I'd hate to do yours. Um accelerated payments and 20 over 20, that all those extra stuff, that is directly on principal, right? There's no interest being touched by that?
Yeah.
Or is there interest pay? Yep,
Well,
so
yeah.
that's
So
all directly on
yeah, it's just affecting your amortization period and the principal amount. So by affecting those two numbers intrinsically, your interest is going to lower, right? Because it's not going the full distance because your interest is calculated over the total amortized period of the mortgage, right? So if all of a sudden that amortization window starts to shorten, so does the amount that you're going to be paying for interest because there's going to be a few years that you're not even paying. So like, you know what I mean? Those tend to drop off. Um, but yeah, so like personally, I think the first bank I was with, I think it was like 10%. So I increased my monthly mortgage payment by 10%, which was fairly nominal to notice, right? An extra 10%. But then I'd get my mortgage payment or my statement, and all of a sudden I'm at like 18, 19 years amortization. I'm like, okay, cool. Like, wow, right? Wow. Like I
right.
think within my first 5 years, I literally had went, yeah, I shaved a good 7 years off my mortgage,
And
right?
did you run both those plans of the
I had no
exa
idea what I was doing. I had no idea. I wasn't a broker at the time, right? I worked in heavy industry, right?
no, I know, but like at the time.
I'd like to take credit, like, and be like, oh, yeah, no, I had this all mapped out and figured out. No, like, it was just like, all I heard was, do this, you pay less. Yay. Is it, right? And so I was like, okay. And then, so to me, it was like every time I get my statement, I'm just like, wow, right? And now, of course, up in the payment 20% may be a little different than up in at 10%, obviously. Um, but I didn't even notice it. The money was coming out anyway, right? Like, so like I didn't
Right.
notice the big increase. And again, it's not everybody has that affordability. Like if you're tight on a budget or if you're very conscious about those things, then maybe, um, but yeah, it was just one of those things. I was just pleasantly surprised. So yeah, I would like to say I did the math, but no, no,
No.
no. I just
But
did what I
but
was
your
told.
but your thing was but your thing was pay down the debt as quickly as possible. Pay
Yeah.
down the debt,
I
pay
was
down the
like,
debt,
for
pay
like an
down the
extra,
debt.
like for an extra 10% every month, I was like, and this goes to principal and
Right.
I'm paying things down faster. I was like, well, that's a no brainer. So then the next year I upped it another 10%, and the next year I upped it another 10%. So when you think about it,
Okay, so ho
that's 30% extra in payments from the first time I signed to like the third
okay,
year. Right.
we didn't get there. Running through this again, I bought on the 31st at accelerated payments of 650 on the 14th and 28th. We get to a year anniversary on the 23rd. We bump it to 20%. Now I'm paying 780 biweekly. It's 15 fucking 60 a month. The next year on the let's say 2024, okay? I can then bump it again if I can
Every
afford the
year,
payment?
every year.
Every year I can bump it by 20% or is it 10?
And whatever the bank's policy is, if the bank is a 20 over 20, like if it's 20%, every year you got the payment 20%.
Okay?
I see the wheels moving.
I'm just I know because I'm just
I see the wheels moving. The smoke is coming at your ears. Like you can do it every year. And if you did that, and sometimes it's one or the other, like you can up the payments or put the lump sum down. Sometimes it's both. You can do both, right? Now, again, who has the extra 20% is obviously a big key. But if you
because
sell a
hold on.
car or if you sell some whatever, right? Like it's just a
If you
kind of,
sell real estate,
or yeah, if
yeah.
you sell real estate. But it's also kind of retraining your mind too. Cause like I know, and I'm just as guilty as most. Like, you get that windfall of cash from a tax-free savings or from a tax return, or you sell a old beater Civic or whatever the case may be, and you're like, oh, okay, I got a little money in my pocket. Most often don't think
Vacation.
exactly, right? And so it's just retraining your brain. Like, yeah, if you
I've
know,
always wanted an ATV.
right. So all these things get said, and then that's where the money goes. Um, But, you do have that opportunity through your mortgage to take that and put it on the mortgage. And then all of a
Okay,
sudden, right?
just so we're on track here. So in 2024, I get the opportunity to go by 20% again. I don't have anything in lump sum. I just make my salary every year. So I increase by another 20%. That means I increase by another $156 bi-weekly, which is $312, which means that my total bi-weekly payment is now, God, 936 a month, which
No, no, no.
is
Sorry.
I
Sorry. You might be doing the math wrong on there. You're
no,
increasing,
936 bi-weekly.
yeah, but you're increasing
Yeah.
so the 20% of the payment. Yeah. So like if it's a
Yeah, the
$100
payment.
payment, yeah, you got 20% of the $100, you can increase it. Right. So
Oh,
yeah,
so we're not okay, so we're not increasing 20% of the actual whole mortgage payment. It's of the additional amount that you've already increased it
exactly.
by.
So if that payment is $100,
Okay.
you're going to increase the $100 by 20%. Right. And that's
So just once again, 650 bi-weekly, accelerated payment brings me 675. I get to 20% of 675, which was 130. 75 by 135. So that increases my payment to 135 plus 650, 785. But then I get to increase it by the 130 by 20% of the 135.
yeah, in another year. Yeah.
Hold on. I'm sticking with this. Times 0.2, $27 a month is an extra 54 per month, which brings my payment to 780 plus 27. I've only increased my monthly payment by $300 a month.
And some of them will
Now,
let you double the payment, right? Like some of them are like every now and then you can double your payment. You just pick what month you want to double your payment. And like that month you doubled your payment, that secondary payment you made goes straight to the principal.
okay, but now you're into a third lever. So the first lever was accelerated payments,
Yeah.
done. Your second lever's 20 over 20.
or
So
15
what's
or
this
10 or whatever the prepayment
whatever
privilege is.
whatever
Yeah.
whatever product the lender is offering, 10
Yeah.
over 10, 15 over 15, 20 over 20. You can do that every year though for then on thenceforth.
Yep.
Okay. What's my third lever?
If you want, this is one that probably most would suggest, and um, but it's possible. Like when it comes time to renew, um, you just keep everything the way it is instead of lowering things,
Hold on. Hold on. Okay, fair enough. But you
right?
mentioned something that you can add an additional payment that goes directly on the principal.
Sorry, yeah, yeah, yeah.
What's that one?
Yeah, the last one is a bit of an unorthodox one, but it's still a potential. It depends on how hungry you are to pay off the payment.
We're going through every lever
So yeah,
that you can possibly think of.
the
So
other
right
one
now
would
you're
be
saying we did accelerated payments, we did 10 over 10, 15 over 15, 20 over 20, and now you talked about adding an additional payment directly on principal. So what is that one we can do?
some of them, some banks within their prepayment policies will allow you to double up the payment, right? And it falls under the
What
same
does that
guidelines.
mean?
So if your payment is $650 for the month,
Biweekly. I'm on biweekly.
you double your payment, right? So
So
whatever
I double both payments or just one?
should just be the one,
Okay.
right? But if ideally, like if you had a monthly payment, let's say, and the monthly payment was
Yeah.
$1,200,
My monthly payment's 1,300, which is how we
if
got to
you
this
if
math.
you had the ability to double the payment once a year, you'd just pay an extra 1,300 that month, right?
Okay.
Again, you'd have to have the capital available, but if you did pay that extra 1,300, that 1,300 is going right to principal.
Principal.
Yeah,
Okay.
not
So
a.
just so
It's the double up your payment is one that I don't see as often as you used to. The
right.
bigger banks will still do it. And it also kind of depends. Like sometimes it's based on the rate you have, if it's like a variable or fixed, right? What they kind of offer for payments, prepayment privileges. But
Well, I mean, we're talking about every lever that you can pull on, but every product at every bank is different. Some will have these things, some will not. Some won't have an app, and some may be a little more aggressive. I understand, like every bank is different, so every lender is different. Everyone has their own rules. It's why you can get different mortgage product if you go from TD to BMO.
yeah,
We ran into this problem this week in the business with BMO. They have a different threshold for purchase plus improvements than other banks, so we had to navigate a client's financing from BMO to a lender that would allow them to do the purchase plus improvements to fix up their house.
yeah,
But that's just, and it was a lender policy. BMO was not bending their specific lender policy, but that's normal in real estate. Banks and lenders will have their own policies that you have to navigate. That's the point of this. I'm doing accelerated rates at 650 a pop. I'm doing 20 over 20. And now I'm even adding an additional payment because I'm just apparently I bought a house for really cheap and I can afford the payments. So now I'm adding an extra payment. So okay, what's the fourth lever then that we're talking about?
So at renewal,
Yeah.
when rates come in and your bank's like, hey, I'm going to offer you this rate and it's lower than what you're currently paying for your mortgage. Amazing.
Okay.
Take the rate. Leave the payment the way it is, right? Because
Okay.
typically you lower the rate, instinctively your payment's going to lower. But you can kind of trick it where you're just like, hey, I'll take your rate, but I want my payment the same because I'm comfortable with what I've been paying.
Right.
Right. So like I want to effectively be paying more than I have to based on this new rent or rate because I'm comfortable with it, but also that's going to fast track things as well, right? Because if with the lower rate they said, oh, okay, well your payment can drop, let's say for the sake of numbers, 1,300 a month, right? Well, okay, I'm offering you lower rate, your payment's going to go down to 1,000. Okay, how about you give me the rate? And I'm just random numbers, but like, how about you give me the rate, but leave my payment at 1,300 because I'm completely comfortable with it. So you're
Right.
juicing the mortgage, right?
Right. I'm just
So
juicing the principal.
now, again, this one's a bit of an unorthodox one. You'd have to be super, like, really into wanting to pay down the mortgage because, like, most people are going to be like, no, I want the lower payment. I want the increased cash
Of
flow and
course.
all that stuff. However, if you're looking for a way to do it, that is another opportunity, right? Where you can just be like, hey, I'll take your rate, but leave my payment where it is. I'm happy with it, right? and then you're
Right.
just going to
I'm
keep chugging
comfortable with this.
along.
I can afford it. Bills aren't killing me. I'm great. Inflation hasn't killed me yet. I got some cash flow.
Yeah, and let the
I'd
money work
rather
for
just
you.
right. Right. So just in this just so we're on the same page here, renewal comes up, interest rate drops because the interest rates come so far down from when we bought the house, which it hasn't because we bought the house in 22. They're only going up. But let's just say, for argument's sake, payment drops from 1,300 to 1,000. We're going to keep it at 1,300 so that the additional gap of 1,300 goes straight into the principal, and I'm not paying so much interest to the big fucking bank.
Yeah, yeah. Like, because in and of itself, it's going to be an advantage, right? Because you're paying above and beyond what you're mandated to based on the rate. It's just you haven't changed your previous payment. Like, why would you
Right.
if you're comfortable with it, right? Um, but yeah, and again, that's an unorthodox one. I'm sure you're probably going to get a late night message from somebody being like, "Don't do this." But hey, you asked the question. It is possible.
And you
it,
know what?
it's out there.
Let the late night messages come. I'll
Listen,
fucking I had fun that night.
there's I cannot begin to tell you. Yesterday, I started getting messages from people because there's apparently fake Instagram accounts out there, and like everybody posts and gets worried about it. I'm like, I'm honored. I'm like, are you telling me I have a fake Instagram account? Wait, there's
Someone made
two?
a fake Instagram account of you?
I got two. There's two fake Instagram accounts out there of me, and I'm just like, I made it. I'm famous. Like I'm on the internet. Like this is amazing. Is nobody else stoked? Everybody's like, no, I got a fake account. I'm just like, yeah, I got fake accounts.
No one makes a fake account of me.
Give
I've
it
yet to
time,
see
my
one,
friend.
but that's okay.
Give it time.
Give it time.
You
When we
too.
get up to your level,
You too. Yeah, yeah, exactly.
your
Yeah,
time will come.
yeah, yeah. I hope you're as excited about it as I
Okay.
am.
We've got okay. Is there any other method you can any levers you can pull for mortgage pay downs? Because like the whole point of this summary is we you bought a house at $600,000, which is Halifax average price point. You're paying $349,000 in interest over the course of 25-year amortization, and the prepayment, the accelerated payment alone took off 3 years. I imagine 20 over 20 is going to take off another minimum of three, probably more. Then I imagine the extra payment is going to take off another two or three. So, like for ballpark's sake, I don't have to run through the amortization, but if we're going through it, you're essentially wiping out 10 years of homeowners before you own your house outright. Let's just be comfortable in
Yeah,
that.
like 10 might be on the high end, but like I know from
Yeah.
experience, mine was my first mortgage was 25 years, and when I got my first, I think it was when I it was my first 5 years in, I think I might have renewed or refinanced or something at the 5 year mark, and I went from 25 and I was sitting around 16 or 17 years for amortization. And all I did
Right.
was accelerated payments, and I took advantage of the annual, and mine was 10%. Like mine was just a 10%
Right.
increase on payment. And I did it every year, like clockwork when they said, go for it. Um, I don't even think I don't even know if I could have doubled up a payment. I don't even think I did.
But you
And,
didn't.
and it was, again, I was blown away that I was at like 16 or 17 years. Now, with that being said, the pendulum swang in the opposite direction shortly after because I was one of those variable rate holders. So then I would get a statement that was like, your amortization is 80 years or something ridiculous, right? So listen, there's good and bad, and but yes, those payments all help. There is another way to do it.
Go
And
on.
I'm
Give me
not
the
even
sketch.
I'm not even going to begin to try to explain it because I don't deal with it. I don't advise it because it's not a product that I get into and understand, but
You're even like rubbing your arms like you
it's
looked uncomfortable.
there's readvanceable mortgages and HELOCs that you can have attached to the house. And essentially, and if anybody's curious, go Google the Smith maneuver. Okay.
Oh, I did a whole podcast on it.
There you
Yeah.
go. So there you go. So that's Smith maneuver and how you can work the readvanceable lines of credit attached to the mortgage. You invest, the increase becomes tax deductible, or the interest, sorry, becomes tax deductible. And it's just, you're washing money through your own mortgage to pay it off quicker. Um, if it sounds tricky, it's because it is. And so you really want to
It
understand what the hell you're doing.
it's a
You
it,
know,
we did a whole like I did an hour podcast. I think like it's episode 34. if someone's desperate to go back that far. Um, Even after an hour, I was still like, I'm not quite I understood the thesis of it,
It
but
to me,
still
you have to be incredibly fiscally responsible to be getting into a product like this. And like Manulife has one too, like the Man One product, where you can, as you pay down the mortgage, it becomes available into an advanceable line of credit, and then all of a sudden you're investing that in the windfalls, and then they come back and then they pay the mortgage. It's all great, and if you can manage it, that's fantastic, but if you can't manage it, don't go anywheres near it, because you could have a mortgage where after 5 years of paying it, your mortgage has gone up,
right,
right? If you
right.
if you screw it
Right.
up and you don't manage it properly, you can get drunk on your own money, essentially, and then
But
all of a
that's
sudden,
but
you're not taking
but
advantage of the
that's
programs,
like
and it's burying you.
but that's like any of these products we're talking about where you can pull levers to pay down mortgages, like, you have to be fiscally responsible because you're essentially just tacking on more and more money towards the principal, which you have to be able to afford.
Doing some of the doing the basic prepayment privileges is, you don't need a university degree in economics to be able to do it. You're simply increasing your payment. You're simply picking the right type of payment schedule, or most advantageous payment schedule, or you get into a windfall and you don't spend it on four-wheelers or Mexico, and you actually put it on your mortgage. But when you get into these more technical ones where you're getting into readvanceable lines of credit attached to your house and Smith maneuver, you're exposing yourself to that risk where if you don't manage it properly, at the end of the 5 years, you're like, "How did my mortgage go up?" Well, your mortgage went
Right,
up because, all the money that you were paying down, you then went and used, and it's still attached to the mortgage. So, like, it can go in the opposite direction. And so for me, everybody likes their products and their angles and stuff like that. I would feel terrible if somebody went into it and then that happened. And then it's like,
right.
right?
But yeah,
I'd rather see
it's
somebody
like
do the
after
prepayment stuff and come to me and be like, "Man, I paid my mortgage down this much faster," and all this other stuff, as opposed
well,
to, right?
it's like for me, for instance, like, I've been very open about this in content as well as with my clients, where, like, I want to buy shitholes. Like, I only wanna buy shit houses because I want to renovate them to force the equity. Simple enough. I have to tailor my enthusiasm and my bias towards my outlook on housing for my clients, because my clients may not be adverse to renovations. My clients may not be adverse to wanting to do more work out of their regular 9 to 5. So, I have to look at it like, this house is not for you, Jason. This is for them. You know what they're looking for. Move in ready, fenced in backyard, good family friendly neighborhood, good paint colors, good cosmetic choices in the kitchen, good cosmetics in the bathroom. Me showing them a shitty house and being like, this is a great buy, like, that's not for the client. And I would feel awful if I sold someone the dream of renovating a house who doesn't have the capital, the skills, or the willingness to learn the skills, and then I call them 3 years being like, "How's the house?" And like, "We fucking hate you. We fucking hate it. This house sucks and it hasn't gotten the value like you said it would." I'm like, "We haven't done anything." "Well, that's because we hate renovate." Like, it's the exact same thing of like, it's you don't want to refer or get excited about a product that you yourself would be worried about the client and what they do with it.
Yeah, and I find myself, I take a lot of that approach when it comes to the mortgage side of things too, because it's just, there's even times when, folks will throw structure opportunities at me and they're just like, "What if I did this?" Or, I mean, oftentimes you hear like, "Oh, well, what about private? What about private?" And it's just like, y you know, there's solutions, yes, and there's solutions out there for you, but, like, what you're looking for can actually sometimes be much more riskier than, than an alternative, and
Right.
so I try to put myself in their shoes where you're just like, if you don't understand the product, don't do it.
Right.
And so, like, that's like
Right.
those advanced strategies like the Smith's maneuver and these readvanceable lines of credit. If you don't understand it, you should not be doing it. Like, that's just a fact of life, right? Um, But, coming from a place of experience with my own personal mortgage, I can at least speak to them like, "Listen, just I see you wanna do biweekly. Why don't we do biweekly accelerated?" Right?
Right.
A
Right.
couple extra bucks on the payment, and here's what it's gonna do. And then instantly it's like, it's understood. And it's so it's attainable that, I get it. Okay, perfect. That makes sense. And then it's like, do your annual increase, whatever the percentage is allowed, right? Do you
Right.
have the windfall every year? No. But even if you're just increasing the payment by that 10, 15, or 20%, that's good. That's doing something,
Right.
right? And so then that
Right.
becomes part of the conversation at the start with the client. It's like, what's your goal? Is the goal the house? Absolutely. But how long do you want to have this mortgage? Right?
Right. And how much interest do you wanna pay?
Yeah. And I
'Cause,
like,
like, I find, like, the only, like, if I'm going back to that clip, which is the whole thing that spawned this episode, is the reason why that hit so and had such a visceral effect was $349,000 in interest. Like, you hit someone with that number, and, like, it almost makes you wanna vomit.
it's every file. It's every file. And this is the part that gets me when you talk about, you know, when people are on the internet talking about how easy this product is and how game changing this down payment amount is and all these other things. And it's like, okay, cool. Are you the one that
You need to
sits?
let that go.
But like, are you the one that sits with the client and reviews an amortization schedule? Because it's all like whimsy and magic and excitement and awesomeness until somebody gets the amortization schedule in the first 5 years. They're like, I put a dollar 20 fucking five on my principal. And you're like, yeah, yeah. Right. And then all of a sudden the reality of the situation starts to hit home. So then it's just like, that's when you're like, okay, yes, but it's not all doom and gloom. There is opportunities to take advantage of these prepayments, your payment frequency, your payment amount, like all those things. You have opportunities to be able to lessen that interest burden. Like I spoke with somebody this week and in a fantastic position to be able to buy whatever they want, right? Through the budget talks, that's the big thing. They're looking at it and they're like, "Oh, wow, like this is the payment?" Yeah. And like this is the interest over the term. And so then the conversation starts to turn to, well, I want to put more money down. Cause right now,
Right.
obviously they're in a position to be able to do that, which is fantastic. But that right away is kind of one of those conversations where it's like, it's great to put as little down as you have to, but that's good over here. But over here, when you look at the amortization schedule, it reflects there too. Right?
Of
So that's when
course.
you're gonna start to see that, "Oh my god, that's how much I'm paying in interest?" Yeah, right? Whereas if you do have that ability to put a much larger chunk down on the mortgage, you can at least say, "Hey, my payments now,"
That's like,
right?
I just did a video about, it was this or that. Andy and I did it, and it was like, would you put 5% down or not? And I said I would only put 5% down on a house. And a few people like literally text me being like, hey, like, I'm curious what your take is on this answer. And my argument was, if I have, let's say when I bought my house, we did the math, it was 54,000 for 20% down. I bought a shithole. So my perspective was, I'd rather pay 5% down, which I think was like, oh, let's see, 5% was like 9 grand for a down payment. I'd rather do the 5% down. That way I have another 45,000 to throw at the house
Yeah.
to renovate it, to force the equity and get out. The only argument, and, like, the other argument that I don't really like is when someone's like, I want to avoid CMHC's mortgage insurance, because, like, the payment's not that big, it's not that big of a deal, it's not gonna change your life to avoid CMHC. The only argument for 20% down or larger down payments for me is saving on the interest and the amortization of the interest you're gonna pay. Like, that for me is, like,
Well,
not even not
the kick in the pants,
right.
and I was explaining this to somebody last night, is, okay, put 20% down. Great. Do you notice that your rate's higher? And that's
Oh,
often the
yeah.
argument. And they're like, "Well, whoa, whoa, whoa,
Yeah.
I can get a
Yeah.
399 at 5% down." Yes, you can. And then it's like, "Oh, but I
Yes.
wanna put 20% down." Okay. Now your rate is 419, right? Or 424 or whatever, like, right? It tends to be like a bit of a quarter higher. And it's like, well, why? I'm putting more down. I should be thanked and
Right.
appreciated by the bank for
No.
putting more down. And it's like,
No. That's more liability for the bank.
well, it's not even the
It's more
liability
li
thing. It's there's still mortgage insurance premium, right? There is a mortgage insurance premium above 20%. You just don't see it. Right? So from 5
I
to
didn't know that.
20%, yeah, so from 5 to 20%, you're paying it. That's why the bank gives you a lower rate. They're like, okay, Jay's putting 5% down. I'm going to give him a smoking rate because he's paying the $20,000 for the mortgage
Right.
insurance premium. So that's on
Insurance.
him. And the insurance, everybody knows, only covers the bank, right? Like it's not insurance for you, it's insurance for the house so that if you default, the bank gets made whole by the insurer. You're still in a world
Right.
of hurting. They're getting made whole. So because they have that risk reassurance that they're good either way, they're going to give you the lower rate. But once you get to 25%, there's still a mortgage insurance aspect. Okay. And from that level up to about 35% down, the bank's going to cover that, right? Because the percentage of it gets lower and obviously it's not as high of amount, but it's still there. And the way that they obviously pay for it is by charging you extra on the rate, right? That's how they balance that, right? So that's when everybody's
I
like,
thought it was I thought it was because CMHC is not covering the mortgage insurance. That's what I thought it was, and banks just didn't like that.
it's that you're not directly
Yeah.
paying for it,
Okay.
right?
Alright, that makes more
So then
sense. Okay.
there's still an insurance
The other thing
aspect, but you just aren't on the hook for it. They are at that point.
the other thing about 5% down versus 20% down payments is, like, when you do the math, like, the change in the monthly payment from, like, 5% to 20%, it's not that great. Like, I never find it to be like, "Oh my god," like, I'm saving $100. It's like usually, like, a difference of, like, a couple hundred, I find, when you're doing because you guys all give me the mortgage calculators, and I kinda do it to play around with numbers.
Yeah, like any of those things, it doesn't like sometimes you'd be very surprised how much of the needle it actually moves. Right? Like
Right.
when folks are like, well, what if I put an extra 5,000 down or an extra 10,000 down? It's like, we've changed your monthly payment by like $8, right?
Yeah,
Or,
it's not it doesn't move it
you know what
much.
I mean? It's always some like drastically, I guess it's always a surprise how little it's moved the needle, but also the same thing when you stretch that amortization out too, right? So oftentimes it's like, some folks are like, well, I want 30-year amortization. And of course, there's a situation where it calls for it. If the ratios are tight or if cash flow's tight, sure. Or if it's a rental property, stretch that out to 30 years. But if you don't need it, why do it? Because you're just going to be incurring more interest, right? Your
Right.
monthly payment may
Right,
feel
right, right.
better or look a little better, but in the background, you're actually paying for an extra 5 years when you don't need to be. So is that worth it? Right. So then that then becomes those conversations up front when you're talking about how much interest you're going to have to pay over the term before we even talk about payments, before we even talk about prepayment schedules. It's really understanding where your down payment range, depending on what you can comfortably afford, is going to put you for that interest over the term, the
Right,
amortization, what's that going to do for you? And once you kind of understand them, that's when we turn to those levers and we're like, cool, now that we figured that out, let's really start to mess with this, right? Let's really fast track this, right? So, and then here's how you
right,
do it.
right. Here's a question, just before we get out of here, because I think we're almost done this topic. How many clients are taking on the prepayment, like the accelerated payment stuff? Like, are you seeing more appetite for it when you're walking through the stuff with clients and the
Yeah.
benefit? Are they seeing the benefits?
Yeah. Once you start to, when I illustrate it in the spreadsheets and you can see that just by picking it, it changes the amortization, um, or how long, then it's a no brainer at that point. They're just like, okay, like if you were going to pick biweekly
Who
accelerated, or biweekly, just do biweekly accelerated.
is it typically by are they pulling on every lever they can that was within or is it just, the 10 by 10 over 10 and the accelerated payments?
The accelerated payments I see right out the gate because we do that at commitment. The annual prepayment and stuff like that, it's really, unless I know
Depends
that
on
they're
them.
doing it, really depends on you guys, right? They may say that that's what they're going to do. Whether or not they do it or not is completely up to
Depends on
them.
me.
Well, it depends on the end user, like if they
I
do
was gonna
it.
say, I'm not selling
No,
extra
no.
mortgage
Oh my
payment.
God, no! I wouldn't look for you to actually give. No, 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 no. Please don't give financial advice. No, um, it depends on the end user, whether or not they do it or not. Right? Like, if the opportunity's there, and go for it. Um, but yeah, definitely when it comes to the accelerated stuff, once you outline that to them, they're just like, okay, well, that's an easy win, right? Like, we'll definitely do that.
Okay.
Yeah,
And you're saying, like, and people are getting more do you think here's a question. Do you think it's because people are getting more educated on this stuff, or it's because you're doing your job in educating them and telling them what their options are rather than just giving them a mortgage? Like, I'm just curious. Yeah,
I
this is where
think, well,
it shines.
yeah, yeah, a little shine there. I mean, it's a kind of a combination of all of it. I think there's a lot more information out there on social medias when it comes to this stuff, like buying houses and investing and how to do
We are
this.
to blame.
It is,
We are putting a dent in buying and
yeah,
selling
yeah,
real estate.
specifically us. I think the knowledge is becoming more prevalent. People are talking about it more. And again, I think it's forced change, right? Because the way everything is priced right now, you really got to understand what's happening, right? Because like, again, it's not like it was 20 years ago or even less. Holy God. I think I bought my house 10, right? So like, it's not 10, 15 years ago when the price points were completely different. Now, when you're a first time home
And
buyer,
and
and you're looking at
and they never
500.
moved.
Yeah,
Like, keep that in mind, like, house prices were stable 10 years ago.
exactly. Like there wasn't the crazy appreciation to them. And, when you're now trying to figure out how to afford a $500,000 starter home, you're now keen to know how I can pay this thing down
Right,
faster, because
right.
all of a sudden the shock and awe of the payment comes and the shock and awe of the amortization schedule comes. So I think people are getting a bit more fiscally prudent in that sense, where they're just like, oh, okay, well, explain this to me. I heard about this in a video. What can you explain this to me? So that
I've
is
watched
definitely
your
good.
video.
And listen, and I take no credit to the video, but even if it was just wherever, right? But they're just like, oh, I heard you can do this. I heard you can do that. Absolutely. And so, but again, as somebody, as a broker, you should be telling that to your clients. That should be part of your conversations with them, because they have goals, right? And so you need to understand what those goals are, and then you match the payments for the goals, or you match the strategy to the goal. So yeah, I think it's definitely become more prevalent, because I think people are just starting to pay attention to that stuff. And when shit is so expensive and people's income is so restricted to everything that they have to pay for, I mean, frig, I'm hearing they're chaining up steaks at Walmart, right? So like everything is pricey. $45 steak should be wrapped up in chain. But, it's it's one of those things where you just have to start thinking outside the box to be like, okay, this isn't the house that my parents got for $80,000 back in the 80s. This is a $500,000 house now that I am going to actually have to pay off, right? So,
Yeah.
you know,
And also, I'm gonna have to pay off, but I also want to avoid paying 25-year amortization. Like, I don't wanna give the bank whatever that amortization money looks like in fucking interest payments.
listen, there'd be nothing. They would be so happy if everybody just got their 25 and 30-year amortization mortgage and
Oh my
took it the
god.
distance. Took it the distance,
Yeah.
right? Like
Yeah, yeah, yeah.
there'd be nothing happier for them. They'll lose no sleep, right? But
No.
if
They'll actually just roll in the money, just sitting there
yeah,
like
like,
Scrooge McDuck,
you know,
or swimming in the money pit.
so for me, it's like, no, less money in their pocket is more money in mine. So then that
Right.
comes down to your three ways: your payment frequency, right?
I'd say
Like,
we talked about 5, down payment. That's one way to get your amortization down or your interest payments down. Accelerated payment, 10 over 10, 15 over 10, 15 over 15, 20 over 20. Then you had your annual additional payment, which goes directly on principal, and then the Smith maneuver. So we'll go 4 because we're both not comfortable recommending the Smith maneuver. And
well,
if you
listen,
want to
I'm
go to
I'm going to
that
say
podcast,
the double up payment one technically fits under the prepayment schedule. So really,
okay,
it is kind of
it's
free. It's
3.
like your payment size, your payment frequency, and your prepayments, right? So one
Okay,
of those three mechanisms you can use to take advantage of it and fast track the mortgage, and
okay.
you should be.
All right, sir. As he stops talking, I didn't mean to cut you off. You can finish your thought.
Oh no, that was it.
I'm
I
not
had
in a
nothing
hurry.
else. I have nothing else. No, I'm good. No, yeah.
All right, sir. Thank you so much. Stay on the line open. Keep the browser open just so till his file finishes uploading. But appreciate you.
This was the cleanest
Bye
podcast
bye.
we've done, actually, by the way.
I disagree.
I was so
Thank you so much for listening to the podcast. You can find our contact information in the show notes. Don't forget to subscribe. Thanks again.